What if a single, unconventional decision could secure your financial future for a lifetime? Are you willing to challenge everything you thought you knew about building wealth, even if it means doing the hard, boring work everyone else avoids? Back in January of 1962, I made a $1,000 investment that completely changed my entire financial life. That one investment has paid me somewhere around $70,000 to $100,000 every single year for the past 62 years. That adds up to over $6 million in total returns, all from an initial $1,000, and it is still paying me today, right now as I am speaking. This $1,000 move back in 1962 taught me more about how money actually works than anything else I ever did. I am going to tell you exactly what I bought, exactly how I found it, exactly how I evaluated it, exactly what my thought process was, and most importantly, exactly how you can apply the same principles to find similar opportunities today, even if you never invest in what I invested in. But I have to warn you about something before we start. What I am about to tell you is going to contradict almost everything you have been taught about investing. It is going to make you uncomfortable because you will realize how many opportunities you have missed by following conventional advice. And it is going to require you to think differently about risk, about returns, about patience, and about what investing actually means. If you are not ready to have your beliefs challenged, if you are comfortable with mediocre returns, if you want to keep doing what everyone else does, then this discussion probably is not for you. But if you are ready to understand how real wealth is actually built, if you are willing to do work that other people will not do, if you want to learn from someone who has been investing successfully for over 70 years, then pay close attention to every word I am about to say. Let me start by telling you where I was in my life in January 1962, because context matters enormously. I was 38 years old, recently divorced, with 3 children to support and crushing child support payments. I was practicing law in Los Angeles, making decent money, but not great money. Maybe $40,000 a year, which was solid middle class back then, but nothing special. I had been saving aggressively, just like everyone told me to do. I was being responsible, putting money into a savings account, and I had managed to accumulate about $8,000 in savings. But I had reached this point where I understood that saving alone was not going to get me where I needed to be. The money was just sitting there earning maybe 3 or 4%, while inflation ate away at it. I was in my late 30s. I was scared about my financial future, and I knew I needed to do something different, but I did not know what. Most of my friends and colleagues were buying stocks based on tips from their brokers, investing in mutual funds, buying real estate with big mortgages, doing all the conventional things. And I watched them make a little money sometimes and lose money other times, and I could not figure out what separated success from failure. Then one day in January 1962, my friend Jake walked into my office. Jake was a geologist I had known since college, and he was one of those people who understood his field at an almost obsessive level. He did not just know geology. He lived it, breathed it, thought about it constantly. And more importantly, he understood the business side of oil and gas production in ways that most geologists did not. Jake spread a geological survey map across my desk and said, "Charlie, I have been studying this oil field for 6 months, and there is an opportunity here that nobody is paying attention to." He started explaining the geological formation, pointing to contour lines and fault structures and reservoir characteristics. And honestly, about 80% of what he said went completely over my head initially. But then he said something that made my ears perk up and changed everything. He said, "These wells have been producing consistently for 30 years. The decline curve is gentle and predictable. The reservoir has excellent pressure characteristics that suggest decades of remaining production, and there is a small royalty interest available for sale that is being completely ignored because it is too small for the big oil companies to care about and too complicated for individual investors to understand." The owner was an elderly widow whose husband had worked in the oil business 50 years earlier. She had no idea what the royalty was actually worth. She just wanted to sell it to simplify her estate, and she was asking $2,500 for it. I had $8,000 in savings, but I knew I could not deploy all of it into one investment. I told Jake I had $1,000 I could afford to invest and asked if he thought that was enough. He said, "Charlie, I think this thing is worth at least $10,000 based on the reserves and production history. If you can get it for $1,000, you should do it immediately." I told him I needed to think about it and study it myself before making any decision. That night, I could not sleep. I kept thinking about what Jake had told me, kept turning over the numbers in my mind, keeps asking myself what I was missing. The conventional wisdom said oil royalties were too risky, too illiquid, too complicated, not suitable for someone like me who was a lawyer, not an oil man. But something Jake had said kept echoing in my head: nobody is paying attention. I had been practicing law long enough to know that the best opportunities often exist in places where nobody is looking, in the gaps and cracks where big institutions cannot be bothered and most individuals are too lazy or scared to do the work. I thought about my savings account earning 3%. I thought about the stock tips my broker friends were constantly pushing on me. I thought about how none of the conventional paths seemed to be actually working for the people I knew. And I made a decision. The next morning, I called Jake and said, "I want to see everything. I want the geological reports, the production history, the well logs, the legal documents, the contracts, everything you have. I want to understand this thing completely before I make any decision." He brought me a stack of documents about 6 inches thick, and I spent the next 3 weeks doing nothing but studying this oil royalty interest. Every evening after work, all day on weekends, I immersed myself in learning about oil and gas production, about royalty structures, about geological formations, about contract law related to mineral rights. It was hard work, real intellectual work, the kind of boring, detailed analysis that most people are not willing to do because it is not exciting and does not provide instant gratification. What I learned during those 3 weeks changed how I thought about investing forever and set the foundation for every investment decision I have made since. First, I learned that most investors are fundamentally lazy. They want simple. They want easy. They want someone else to do the thinking for them. The oil royalty required me to understand geology, petroleum engineering, contract law, financial analysis, tax implications, and market dynamics. It was genuinely complicated. And that complexity was exactly why it was mispriced, because most people, even smart, educated people, were not willing to do the work required to understand it. So they just avoided it entirely, which meant there was no competition for the asset and the price did not reflect the true value. Second, I learned that the best investment opportunities are almost always in unglamorous, boring assets that nobody wants to talk about at cocktail parties. Everyone wanted to discuss the hot growth stocks or the exciting real estate developments or whatever was trendy that year. But the boring oil royalty that nobody was paying attention to had far better risk-adjusted returns than almost anything else I could find. Third, I learned that when you do your homework thoroughly, when you really understand something at a deep level, your conviction becomes unshakable. By the end of those 3 weeks, I knew that oil royalty better than anyone else who might possibly bid on it. I understood the risks. I understood the upside. I understood the geological formation. I understood the legal structure. I understood the tax treatment. That depth of knowledge meant I was not gambling or speculating. I was making a calculated investment based on thorough analysis. But I still had a problem. The widow wanted $2,500, and I only had $1,000 I was willing to invest. I had to make a choice. I could walk away and wait until I saved another $1,500, but that would take months and I would risk losing the opportunity. I could try to borrow the additional money, but I was already stretched thin financially, and taking on debt felt dangerous. Or I could make an offer with what I had and see what happened. I decided to write a letter to the widow explaining my situation honestly. I told her I was a lawyer. I understood what she was selling. I was not trying to take advantage of her, but I only had $1,000 available to invest. I offered her $1,000 cash with immediate closing. No contingencies, no complications, just a simple, clean transaction. I explained that I could close within a week if she accepted. 2 days later, she called me and said yes. She told me later that she had been trying to sell that royalty for over 3 years, and nobody wanted it because it was too small and too complicated. She was just relieved to have someone who actually understood what they were buying and could close quickly without creating problems. We signed the paperwork the following Friday afternoon. I wired the money on Monday morning, and just like that, I became the owner of a 1/16th royalty interest in 17 producing oil wells in the Wilmington oil field in Southern California. I just deployed $1,000, which was a significant amount of my total savings, into something that everyone around me thought was crazy. Now, let me tell you what happened next, because this is where the real lesson is, and where most people completely misunderstand how investing actually works. For the first 6 months, absolutely nothing exciting happened. I owned this oil royalty. I had spent $1,000, which was a big chunk of my available capital, and I just waited. No excitement, no quick wins, no immediate gratification, just boring, patient waiting while the wells kept pumping and the oil company kept sending me small monthly checks. The first check I received was for $87. The second month was $92. The third month was $106. I was receiving roughly $1,000 to $1,200 per year in royalty payments, which worked out to about a 10 to 12% annual return on my $1,000 investment. That was better than my savings account was paying, but it was not spectacular or life-changing. My lawyer friends thought I had lost my mind. They would ask me what I had invested in, and I would say oil royalties, and they would look at me like I was insane. Where is the upside, Charlie? When are you going to sell it for a profit? How long are you planning to keep your money tied up in this thing? But I understood something they did not understand. I was not investing for a quick flip or a fast profit. I was buying a cash-flowing asset that would pay me every month for decades. And more importantly, I was learning. I was learning how oil and gas economics worked, how royalty payments were calculated, how production rates changed over time, how oil prices affected my income, how the tax treatment worked. I was building knowledge and expertise that would serve me for the rest of my investing career. Over the next 5 years, several things happened that validated my investment thesis and taught me lessons I have used ever since. First, oil prices started rising in the mid-1960s as global demand increased faster than supply. My monthly royalty checks went from $90 to $150 to $250. The same wells, the same production rates, but higher oil prices meant higher revenue and higher royalty payments to me. Second, I learned how oil and gas taxation works and discovered that royalty income has extremely favorable tax treatment because of something called depletion allowances. I was keeping far more of my cash flow after taxes than I would have kept from equivalent dividend income or rental income. The government was essentially subsidizing my investment returns through the tax code. Third, and this is crucial, I watched other investors chase hot stocks that went up fast and came down faster, while my boring oil royalty just kept quietly depositing money into my account month after month, year after year, never exciting, always reliable, completely uncorrelated to what the stock market was doing. Fourth, I realized this was what I now call anti-fragile investing. The Wells did not care about stock market crashes. They did not care about recessions. They did not care about political chaos. As long as people needed energy, those wells kept pumping, and I kept getting paid. That reliability, that predictability, that independence from market sentiment was worth more than any amount of potential upside from speculation. By 1970, 8 years after my initial investment, I had received approximately $18,000 in cumulative royalty payments from my $1,000 investment. I had already made back my initial capital 18 times over, and the wells were still producing strongly with no signs of depletion. By 1980, I had received about $45,000 total. By 1990, about $90,000. By 2000, about $150,000. By 2010, about $230,000, and the wells just kept producing. Some wells were shut down over the years as they became uneconomical. A few were redrilled and enhanced with modern extraction techniques. Production rates varied depending on oil prices and reservoir characteristics and technological improvements, but that stream of income never stopped. In the early 2000s, one of the major oil companies approached me about buying my royalty interest. They offered me $300,000 cash for immediate sale. I calculated quickly in my head. They were offering me about 4 times my annual income from the royalty. That would be like selling a rental property that generates $75,000 a year in profit for $300,000. The math made no sense. Why would I trade a perpetual income stream for a lump sum that was only a few years' worth of payments? I said no immediately and did not even consider it seriously. That decision to hold rather than sell turned out to be one of the smartest moves I ever made. Between 2010 and 2022, as oil prices went through massive cycles, as fracking technology revolutionized American oil production, as California became increasingly hostile to oil and gas extraction, my little royalty interest just kept generating income. Some years the checks were smaller, maybe $50,000 annually during periods of very low oil prices. Other years they were substantially larger, over $100,000 during commodity boom periods. But the average over those 12 years was approximately $70,000 to $80,000 per year. That is an additional $840,000 to $960,000 from 2010 to 2022 alone, which brings my total cumulative income from that single $1,000 investment to well over $3 million as of 2022. And the wells are still producing today as I speak to you, still sending me monthly checks, still depositing money into my account without any effort or attention required from me. Some years recently, with oil prices elevated, I have received over $100,000 in a single year from that investment I made 62 years ago with $1,000. Let me say that again slowly so you understand the full impact. $1,000 invested in 1962 has paid me over $3 million in cumulative income over 62 years and is still paying me over $100,000 per year today. That is a return that most people cannot even comprehend because they have never experienced anything like it. But here is what I really need you to understand, because the specific investment does not matter as much as the principles behind it. I did not get lucky. I did not have inside insight or information. I did not know the future. What I had was a willingness to do work that other people were not willing to do. A willingness to invest in something boring and complicated that nobody else wanted. A willingness to think long-term when everyone else was thinking short-term. And a willingness to trust my own analysis even when it contradicted conventional wisdom. Those principles, those behaviors, those ways of thinking, that is what created the return. The oil royalty was just the vehicle. And those same principles can be applied to countless other investment opportunities that exist right now, today, all around you, that you are probably ignoring because you are looking in the wrong places, or because you are not willing to do the work required to find them and evaluate them properly. Let me break down the specific principles that made this investment successful. Because if you understand these principles and apply them consistently, you can find similar opportunities in your own life, regardless of whether you ever invest in oil royalties. Principle number 1 is what I call hunting where the elephants are not. When I bought that oil royalty in 1962, everyone else was chasing growth stocks, following their brokers' recommendations, buying mutual funds, doing what the financial services industry told them to do. The big investment firms were not interested in small oil royalties because the transaction costs did not justify their time. The fees were not large enough to matter. The assets were too illiquid to trade profitably. Individual investors were not interested because it required actual intellectual work, actual specialized knowledge, actual analysis and thinking. So there was this pocket of the market where prices did not reflect true value purely because nobody was paying attention. This is where real opportunities always exist. You are never going to find great investments by reading the Wall Street Journal's recommendations or listening to financial television or following what everyone else is doing. You find them by going to places nobody else is looking, by studying industries and asset classes that seem boring or complicated, by being willing to do work that other people are not willing to do. Today, those places might be small private businesses that aging owners want to sell, small cap stocks that no analyst covers, real estate in secondary markets, equipment leasing, royalty interests in intellectual property, all sorts of unglamorous assets that do not make exciting conversation, but generate excellent returns for people willing to understand them. Principle number 2 is the absolute necessity of deep understanding before you invest even $1. I spent 3 full weeks studying that oil royalty before I made my offer. 3 weeks of evenings and weekends, reading geological reports, production histories, legal documents, financial analyses, learning about an industry I knew nothing about. Most people will not spend 3 hours researching something before they invest thousands of dollars in it. They will read a social media post, watch a short video, hear a tip from a friend, and they will immediately buy without any real understanding. Then they wonder why they lose money. I have never made a significant investment in anything I did not understand thoroughly. And I mean thoroughly, not superficially. When I say I understood that oil royalty, I mean I could explain the geological formation in detail. I could read and interpret the well logs. I could calculate production decline curves. I could analyze the contract terms and their legal implications. I could estimate the present value of future cash flows under multiple price scenarios. That level of understanding meant I was not gambling. I was not speculating based on hope. I was making a calculated investment based on knowledge and analysis. And that knowledge gave me the conviction to invest when others were scared or confused. And it gave me the patience to hold for decades when others would have sold after a few years. You cannot develop real conviction without deep understanding. And without conviction, you will panic at the first sign of trouble or sell at the first small profit. And either way, you will never achieve the kind of returns that actually build significant wealth. Principle number 3 is the power of cash flow over capital appreciation. When I bought that oil royalty, I was not thinking about selling it later for a profit. I was not hoping to flip it to some greater fool at a higher price. I was buying a stream of cash flows that would deposit money into my account every single month for the rest of my life, regardless of what happened to markets or the economy or anything else. This is a completely different investment mindset than what most people have. Most people invest hoping the price goes up so they can sell for more than they paid. That is speculation, not investing. Real investing is about buying assets that produce income, that generate cash, that put money in your pocket month after month, regardless of what the market price does. The oil royalty paid me whether the stock market went up or down, whether the economy was in recession or expansion, whether I was paying attention to it or not. That reliable income stream gave me financial security, gave me options, allowed me to take career risks I could not have taken otherwise. And most importantly, it compounded over time as I reinvested those cash flows into other opportunities. If you are only thinking about buying assets hoping the price goes up, you are playing a dangerous game that most people lose. If you are thinking about buying assets that generate income and cash flow, that pay you to own them, you are playing a game where the odds are heavily in your favor. Principle number 4 is understanding the difference between price and value and being willing to act decisively when you spot a significant divergence. That widow was asking $2,500 for the oil royalty. I paid $1,000 for it. And based on my analysis, the present value of the future cash flows was somewhere between $10,000 and $15,000. That is a massive discount to intrinsic value. And it existed purely because of market inefficiency, because nobody else bothered to do the analysis, because she was motivated to sell and did not have sophisticated buyers competing for the asset. These opportunities exist constantly in every market and every asset class. But most people never find them because they are not looking, or because they do not know how to calculate intrinsic value, or because they are not willing to act when they do find them. I have spent my entire investing career looking for these divergences between price and value, and I have made far more money from finding undervalued assets than from any brilliant predictions about the future or any sophisticated trading strategies. The market is reasonably efficient for well-known assets that everyone follows, but it is incredibly inefficient for obscure assets, for distressed situations, for anything that requires specialized knowledge or significant effort to analyze properly. That is where you want to focus your attention if you want to find extraordinary returns. Principle number 5 is the enormous advantage of patience and extremely long time horizons. I have held that oil royalty for over 62 years. 62 years. Most people today cannot hold an investment for 62 days without checking the price obsessively and getting nervous about volatility. The average holding period for a stock in the modern market is less than 1 year. People have completely lost the ability to be patient, to let investments mature, to allow compounding to work its exponential magic over long periods. They want instant results, quick profits, immediate gratification, and because they want those things, they never get them. Instead, they get transaction costs, taxes on short-term gains, emotional stress from constantly monitoring prices, and mediocre returns that barely keep pace with inflation. When I bought that oil royalty in 1962, I was not thinking about what it would be worth in 1 year or 5 years. I was thinking about whether it would still be paying me income when I was 70 years old, when I was 80, when I was 90. And it has. It is still paying me today. That long time horizon meant I never panicked during oil price crashes, never got shaken out by short-term volatility, never made emotional decisions based on temporary market conditions. The longer your time horizon, the more you can take advantage of opportunities that short-term thinkers avoid, and the more you benefit from the exponential power of compounding returns over decades. Now, let me address what I know you are thinking, because everyone asks this when I tell the oil royalty story. That is great for you, but I cannot invest in oil royalties. I do not know any geologists. I do not understand the oil business. So, how does this help me? And my answer is, the oil royalty is just an example. It is just one specific application of universal principles that work for any asset class in any market. Let me give you a modern equivalence that you could pursue right now using the exact same framework. Small business acquisitions in boring industries are probably the closest equivalent available today. There are literally millions of small businesses in America. Plumbing companies, HVAC companies, small manufacturing firms, distribution businesses, service companies of all types that are owned by aging baby boomers who want to retire and have no succession plan. Many of these businesses generate steady, predictable cash flow, have durable competitive advantages in their local markets, require modest capital to operate, and can be bought at very reasonable valuations because nobody wants them. They are not sexy. They are not technology companies. They are not going to make you a billionaire. But if you buy a solid small business at 5 or 6 times earnings, run it competently, or hire good management, take out the cash flow, and hold it for 20 years, You will generate returns that blow away anything you could get from stocks or real estate or any conventional investment. This is exactly analogous to my oil royalty. You are buying cash flows that nobody else wants at a reasonable price. You are committing to hold long term. You are willing to do the work to understand the business thoroughly, and you are benefiting from market inefficiency. Another modern equivalent is what I call orphan stocks, which are small, publicly traded companies that are too small for institutional investors to bother with, too boring for retail investors to get excited about, but that have solid, profitable businesses generating cash. These companies often trade at single-digit price-to-earnings ratios, pay reasonable dividends, have little or no debt, and just quietly compound value year after year while everyone ignores them because they are not featured on financial television and do not have exciting growth stories. If you are willing to do the work to find these companies, to read their financial statements carefully, to understand their businesses and competitive positions, and to hold them for 10 or 20 years through all the market volatility, you will generate excellent returns. I have done this many times over my career. Another equivalent is real estate in secondary or tertiary markets. Not the hot coastal cities that everyone is chasing and that have been bid up to insane valuations, but solid middle American cities where you can still buy rental properties at reasonable capitalization rates, where the rental yields actually make economic sense, and where you are not just speculating on appreciation, but buying for cash flow. If you buy a rental property that generates 8 or 9 or 10% cash-on-cash return from rent after all expenses, and you hold it for 20 or 30 years while the rent gradually increases with inflation and the mortgage gets paid down by your tenants, you are going to do extremely well. This is the same basic principle as the oil royalty, buying predictable cash flow at reasonable prices and holding long enough for time and compounding to work their magic. Let me tell you one final thing that I think is the most important lesson from this entire story. The reason I was able to make this investment, the reason I was able to find this opportunity and have the conviction to act on it, was not because I was smarter than everyone else, or because I had some special gift, or because I got lucky. It was because I was willing to do work that other people were not willing to do. I was willing to spend 3 weeks studying boring geological reports when my friends were playing golf or watching television. I was willing to look uncool and unsophisticated by investing in an obscure oil royalty when everyone else was talking about hot growth stocks. I was willing to be patient and hold for decades when others were flipping investments for quick profits. I was willing to be different, to go against the crowd, to trust my own analysis, even when it contradicted conventional wisdom and popular opinion. And this is the part that makes people uncomfortable when I say it. But it is absolutely true. Most people are not willing to do these things. Most people want investing to be easy, to be fast, to not require much thought or effort, to be something they can do passively while focusing their time and attention on other things. And because most people want that, most people get mediocre results. They follow the herd, they buy what is popular, they sell when everyone else is scared, they pay high fees to middlemen, and they spend their entire lives working hard and earning good money, but never building significant wealth because they are not willing to think differently about how money and investing actually work. You are capable of doing better. You are smart enough. You have access to enough capital. You have access to enough information. What you might not have is the willingness to do the work and the discipline to be patient. But those are choices, not limitations. You can choose to hunt where others are not hunting, to learn what others are not learning, to invest in what others are ignoring, and to hold when others are selling. If you make those choices consistently over many years, you will find your own version of my oil royalty. It will not be the same investment, but it will be the same principle, and it will generate the same kind of life-changing returns. That $1,000 I invested in 1962 has now paid me over $6 million, and it is still paying me today. That is the power of intelligent, patient investing in cash-flowing assets that nobody else wants. Now you know the secret. What you do with this knowledge is entirely up to you. Let's talk for a moment about why this is so difficult, especially in the world we live in today. It is not just about laziness. It is about the constant barrage of noise that pushes you toward the exact opposite behavior. Your phone, your computer, the financial media, they are all designed for speed and distraction. They thrive on volatility, on the next big thing, on quarterly earnings reports, on constant updates. This environment actively punishes the kind of deep, focused work I described. It makes patients feel like you are missing out. When you see someone else supposedly getting rich quick on a hot trend or a new technology, your instinct is not to go read a 6-inch stack of legal documents about a local plumbing company. Your instinct is to feel envy and anxiety and to wonder if you should jump on that trend too before it is too late. This is the greatest barrier you will face. It is not a lack of opportunity, but the psychological difficulty of ignoring the crowd. The crowd is loud, it is confident, and it is almost always wrong about the long term. So, how do you fight this? How do you develop the mindset I am talking about in a world that is built to distract you? You have to start by building what I call an informational moat. You must deliberately and ruthlessly curate what you consume. Stop watching financial television. It is entertainment, not analysis. Stop reading the headlines that are designed to make you panic or get greedy. Stop refreshing your portfolio every 5 minutes. Instead, you must replace that time with reading things that are old and have stood the test of time. Read annual reports from 10 years ago, not just the latest quarter. Read detailed biographies of people who built things over decades. Read textbooks on obscure industries. The goal is to train your brain to think on a different timeline, not in days or weeks, but in decades. When I was studying that royalty in 1962, there was no internet. There was no social media feeding me distractions. This was a significant advantage. I had no choice but to sit alone with the documents and simply think. You must artificially create that same environment of focus for yourself. The second thing you must do is start small, but start with something real. Do not try to find your $6 million investment tomorrow. That is not the goal. Instead, try to find one small thing you can understand completely. Maybe it is not an oil royalty. Maybe it is the local car wash. Go sit there for a Saturday. How many cars come through? What is the average price? What do you think their expenses are for water, soap, labor? Who are their suppliers? You might not ever buy the car wash, but you will have engaged in the process. You will have done the intellectual work of valuation. You will have trained the do the work muscle. Do this repeatedly in different small niches, and you will start to see the world differently. You will begin to spot the inefficiencies. You will see the gap between the shiny object everyone is chasing and the boring, cash-flowing asset everyone is ignoring. The final piece of this is accepting that you will look and feel out of step. You must be comfortable with that. Your friends will be talking about their crypto gains or the hot tech stock that doubled, and you will be analyzing the balance sheet of a regional waste disposal company. It is not glamorous. But wealth, real, durable, generational wealth, is rarely built on glamour. It is built on the predictable, the unsexy, and the profitable. It is built on finding value where no one else is looking, and then having the patience and the conviction to wait. The work is hard, but the alternative, a lifetime of chasing trends and earning mediocre returns, is much harder in the long run.